Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hey, thanks, Jim. Happy October.
Yes, you're my first guest on the first.
There you go.
Danielle, a study has found that Toronto and Vancouver are the most valued home sites in Canada, and a Swiss firm has found that Munich, Frankfurt, and Toronto are the most overvalued real estate markets on the planet. What's going on there? And Vancouver's not far behind. Is this a problem, something that people should be worried about?
Oh, is it ever, right? Because we have, they're lovely places to live, but even before the pandemic, of course, this was a scenario where prices were rising much faster than gains in overall income. And this is just not just in those big cities. If you take Canada nationally, in the 15 years from, say, 2005 to 2018, the price of the median home rose at 88%, where the median household income rose 45%. So nearly twice as much gain in the price of housing relative to income in the country. And the only way we've been able to afford to keep paying those prices and have that escalation is by people taking on more and more debt. So as interest rates came down, the logic was, great, well, we can afford higher payments, but it got to the point now where, even with low rates, because principal is so huge on the debts, because people have had to pay so much for housing, they're, paying more and more now in mortgage payments. So low rates are a tiny fraction of it. It's the principal cost that's got so high. So you get into the pandemic, of course, and people are looking for ways to distance themselves, to have more green around them, fewer neighbors, migration out of condominiums and into single-family houses, which tend to be even more expensive. So this has really just exasperated this fact that prices, and this is what the UBS report was referring to, is that in Toronto, Vancouver, they are the most expensive property markets in North America relative to income and rents, and in the world, Toronto ranks third behind, Munich and Frankfurt, and then Hong Kong's up there as well. But so, it's not a good thing because, as we've discussed many times, it just puts so much strain on people trying to reach for, shelter, which is essential. Now, an interesting thing that's developing is that with although there's been this continued surge in prices, people have been moving in the first half of the year. And indeed, the lockdown in the first and second quarter really sort of had pent-up demand that fueled crazy real estate activity in the third quarter. But what we also see is that the rents in major urban centers have been coming down. And this is not just in Canada. This is in major centers like San Francisco. Rents are off about 11%. In New York City, this is happening. So as less international students, less international travelers coming into those, hot spots, less household formation because of all the income loss, because of, businesses closing, all that sort of thing. And the people who are working are migrating out of the city when they can work from home. And there's some of that sort of likely to be permanent even after the pandemic passes. So you've just got this general consolidation, both in office space and in home space in terms of downtown areas, and moving to where people can either live with extended family or property sharing with relatives or friends. There's an amazing statistic, Jim. 52% of the people 18 to 29 are today living with their parents, and that's even past the 48% that were doing so during the Great Depression. So, as I say, there's this big consolidation move going on in housing, and those young people who have lost employment, this is the second Great Recession in the last 12 years that's hit this cohort. The millennials, the Gen Zs and Xers, everyone sort of behind the boomers that had a fraction of the boomers' wealth coming into this very difficult period and are now facing the most adverse financial conditions since the 1930s. So all of that makes them, not able to afford to buy anything close to the prices that are on offer. And this is a problem for an aging cohort of baby boomers who are overhoused and undercashed. They have, it's one thing as interest rates have come down, it's driven the price of properties higher, which has benefited the balance sheets of those who own real estate. That's all well and good. But the adverse, or the opposite of that, is that, that same cohort of people are hoping to extract, 4 and 5% a year from their retirement savings once they leave work. And at the same time, those rates have come down. What was a guaranteed rate of interest on GICs and government bonds and things of 5 or 6% in 2000 is today less than 1%. So this whole 4% rule has totally been turned on its ear in terms of reasonable expectations for withdrawal. So this comes back to, if you're earning a quarter of what you once were in terms of income on your savings, and now you're looking to either because of layoffs, which are becoming permanent right now, you're having to leave the workforce early, or you're trying to be retired. You look at, okay, well, now I have to figure out how to lower expenses, how I can raise some cash. And this is where I think the problem comes for the real estate market, right? Well, you've got everyone in a panic to buy these houses for various reasons. But on the other end of that, you need buyers. And as I've just described, the younger demographics are not capable or able to keep up with this, for both from an employment reason and because of the affordability ratios being so horrendous. And then you've got this older cohort who are finding themselves increasingly cash-strapped and needing to raise cash. So this is where there's a gap, and it's generational, and I think it's going to persist. And I think in Canada it's particularly garish, and so it is likely that we're going to see downward pressure on housing. Just as we saw frantic buying in security markets in episodes of low rates, we've seen this frantic buying of uneconomical pricing in real estate. And I think that ultimately that's going to be something that has to mean revert. And in past episodes, whether it's been in other countries like the United States up to 2006, or in Japan in the, late 80s into the 90s, or whether it's even in Canada in the last couple episodes, which are far out of people's memory, but in the 80s and 90s we had a major real estate correction where prices typically drop more than 25% and take many years to recover. So if that is the scenario that is likely on these facts, it's just a question of when it ultimately, when the weight of that picks up momentum. And I think that it's quite likely it could happen, in the next year or two, and that's going to really be difficult for people that have become so highly indebted, I think heavily levered on these presumptions of ever climbing home prices.
What does that do to people who are relying on a reverse mortgage?
Well, it's interesting. I was just writing about this phenomenon. So if we look at this generational problem of who's got the bulk of the assets, it is the, over 50 crowd, the baby boomers, and who, as I say, are increasingly cash strapped, having to find ways to fund their life. And what they're doing is they're doing things like extracting equity out of their homes, whether it's in, lines of credit, or whether it's this push for reverse mortgages, which have become highly popular. It's the have your cake and eat it too thinking, which I always comment on, because, ultimately you're gouging out your home equity to pay your bills, and it's kind of a bad strategy. Very rarely will that be a good strategy. Maybe in a very short-term window if someone has a couple of years to live or something, perhaps. But generally speaking, it's a terrible strategy. It's high fee. It's eroding the principal asset. The bulk of inheritance to offspring typically has come from the primary residence being the main asset that most people have. So as low rates continue, which I think they are going to, because we're in this heavily depressing environment for economic growth. There's no inflation in terms of earnings growth, in terms of corporate earnings in this environment. And I think that so rates may indeed stay low for a very long time, and that's just making it all the worse for people looking to draw income. And so they are doing these things to cannibalize the equity in these overvalued assets that they have in their home. And that means that they, if prices are dropping and they're cannibalizing the equity they have, that's a pretty negative feedback loop. And also for their offspring, it's quite likely that there'll be less to pass on in inheritance to this group, which is already financially disadvantaged, as I say, by these two back-to-back, the worst recession since the 30s in the last 12 years.
We'll have more with Danielle Park right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, a survey found 48% of Canadians expect home prices to rise over the next 6 months. Is that a realistic expectation in the middle of one of the worst recessions ever?
Well, you see, it goes back to, for example, the UBS study, which was looking at why prices have gone up in the first 9 months of 2020 amid this global pandemic and the deepest recession since the 1930s. And the three factors that they cite are the fact that home prices are backward looking. So as I like to point out, optimism rises and falls with price. So if price has been most recently going up, people feel optimistic that that will continue. And the majority of home buyers have had, there's been a bunch of, as we know, government support programs and deferrals that have come in for people not having to pay their debts, their taxes, their remittances. That has left them with a sort of an elevated sense of cash on hand. And also there's been these credit facilities for companies and various support, which has enabled some businesses to keep their doors open. The government programs in the last several months have sort of deferred the carnage, so to speak. Initially there was a hope that there'd be a quick bounce back, that we'd have a vaccine, very shortly, that suddenly, everything would be back to normal. Well, of course, as each week goes by here, as we head into the second wave all over Britain, Spain, Germany, Canada, all these places are discovering that we're heading into this really onerous period for the winter as everyone goes inside and the spread continues in schools and all that sort of thing. So it's not surprising that optimism has been high, but that's generally speaking a bad indicator. And what you're likely to see is that, at the same time, as I was pointing out, only 19% of Canadians surveyed said they expected the economy to strengthen over the next 6 months. So this is very incongruent. 44% of them think housing prices will go up no matter what, no matter what's happening to businesses and individuals in the country. Obviously, that's irrational because it's ultimately based on, as I say, rents and income. So if job losses are mounting, which they are, we're seeing, and this has been kind of my thesis from the beginning, that we would see this initial lockdown, then a recovery phase where the economy opens up, a lot of businesses open up, and then they realize that incomes are not going back to anywhere close to where they were in 2019, and you get this next wave of permanent layoffs, and we're indeed seeing that. This week we've had, tens of thousands of layoffs in not just things like airlines, but also in, hospitality, and Royal Dutch laid off 9,000 people, Disney laid off 28,000 people. So these are into this next phase where people are realizing that these layoffs and job losses are likely to be permanent. And we're not finished with those yet. So it's just, this is going to bring a period of pessimism, right? What's that saying? It's always a depression when you lose your job and a recession when your neighbor does. So, I think we're into the weeds of that now. And so, at the same time, a lot of these deferral programs are coming to an end. Like, they had said people didn't have to file their tax returns or pay their and until the end of September, and now here we are. And CERB was being revamped, because so many people are going to fall off. So there's all these things happening to the income front at the same time as rents are falling. So that pushes pressure on, levered real estate investors if they can't get the same level of rents that they were banking on. And I think those things are all likely to put a lot of pressure on real estate.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking to Danielle Park. Danielle, a survey found 71% of Canadian small businesses are still missing what they would call their regular revenue. What does that tell us about the long-term job prospect for people in Canada?
Well, this is back to this. The early phase euphoria was kind of like, oh, this is just a one-quarter shutdown, and then we'll be back to normal shortly. But more pragmatist people were saying, wait a minute, it's likely that when you lose this big chunk of income, and it's not just for a couple of weeks, it's for many months, that income is lost in many ways forever, and the profitability for the whole period gets crunched, and that's when people start looking to do layoffs. And indeed, some of the forecasts that I was seeing even this week were more sort of saying they don't expect sales revenue numbers to come back to where they were in 2019 for potentially 3 to 5 years. So this is kind of, again, back to this theme of that the recession at hand is not only extremely deep, it is likely to be stubborn and longer lasting than most people have prepared themselves for. And so, I thought it was the way this loop works, right? It's so interconnected. Remember, for example, in the spring, how we were all happy to discover that many insurance companies were giving us breaks on car insurance, for example, because people were driving so little and the amount of accidents were down. And so cash crunch was tough, so insurance companies were giving people a break. And that was all helpful to cash flow in the short run. But in the longer run now, what's happening is many of those insurance companies are laying off people, right? So, we saw a couple of big names announce thousands of layoffs from the insurance business. And not only that, but they are now canceling or dramatically increasing things like commercial insurance for anyone in the hospitality industry. So bars and restaurants and venues, live music, things like that are finding that they're not able to get insurance coverage as their policies come up for renewal. So although it was a boost in the short run, in the long run what's happening is now that the economy is, seeing the negative effects of that lost revenue. So this is the kind of thing that I'm talking about. And the estimates are, that you could see at least a third of businesses close permanently in the next year or so. And so that really has sort of unprecedented knock-on effects. They're thinking that perhaps in places like New York City that perhaps 15% of currently at the end of September, just 15% of the office workers had returned. And that's catastrophic for so many businesses that depend on that flow of humans into certain centers. And we're seeing the same thing in Toronto, where it's like a ghost town. The path, underground businesses, all that sort of thing, are really just starved for any kind of revenue. So it's going to be a long slog, and I think that's why I'm the most concerned. That's why I was warning, before the pandemic, that when people are as highly levered, have so little savings, have so much, eggs in only the housing basket, this sort of thing. Here's an example. Alberta has had, a higher income, household income than most of the provinces because of the oil and energy patch, which were higher paying jobs. So the average household income in Alberta up to about 2018 was something like $98,000 relative to the rest of Canada. The national median average was about $87,000. But it's not about high income, right? It's about how much of it we keep and how much we direct to paying essential things like shelter, for example, off, so that it's not a negative cost, so that we have, relatively little in terms of fixed costs. Because when you look at the national figures now, Canada nationally had about $1.80 of debt for each dollar of income at the end of 2019, but Albertans had about $2.10 of debt for every dollar of income. So again, they came into the first oil shock in 2015, spending lots of expensive leases on trucks and all the toys and bells and whistles, spending tons. And then they get a big income shock, and that's been very hard. Right now you've got 30% vacancy rate in real estate, for example, in places like Calgary, and you've got this weight of debt that people are trying to service as their income continues to fall now, during the pandemic. So I think the thing we can learn from all this is that we must prepare for rainy days. We must invest in things that are productive in the long term, that will help us to save money, not just goose up the price of assets so that our cost structure is so expensive and harder to maintain. But it's always about how do we get our things paid for, how do we waste little, save more, because ultimately there will continue to be shocks, and this pandemic will pass at some point, but we are not through it yet by a lot. And I think that we're going to probably need income support from the government for a long time here before, people are able to figure out new ways to be self-supporting. So the best thing we can do in this, I think, is learn from the experience and hopefully shape our behavior so that when the next shocks hit, people are not taken so off guard.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website, jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.